Hey, so one day you are going to die. How is that for a podcast opener? Well, it's true though. At some point, it's going to be our time to go. We don't know when that's going to be. One of the most important financial decisions you're going to need to make is about life insurance, and it's actually one of the easiest steps to implement. The problem with life insurance is I find a lot of times people haven't done it because they're not quite sure where to pull the trigger. How much life insurance do I need? I know I probably do need life insurance, but how much? What type? And it seems a little bit of a confusing question because I don't want to shoot too low and not leave enough money for my family, for those that I need to care for. But I also don't want to shoot too high and be overpaying for something that I don't really need, is way beyond what I actually need in my circumstance. So let's talk about that today. How do you settle on an appropriate amount of life insurance coverage? And I also want to talk briefly about types of coverage and who even needs it in the first place. So let's start right there. Who needs life insurance? Does everybody need life insurance? Well, short answer is no, not everybody does. I would say most people could use life insurance. For most people, it's going to be a good idea. It really comes down to, is there anybody that financially depends on you? Not, is there anybody that loves you or cares about you or will miss you when you're gone, but is there anybody financially that does rely on you, at least in part, for their financial support? If so, you probably do need life insurance. Now, what might be some situations where that's not the case? Maybe you're a spouse, but the other spouse works, and their income alone would be enough to take care of the family's needs, and yours is a little bit. It's just extra. It's not necessary. Or you're single and you're don't have any dependents, don't have any kids, and probably don't need life insurance there. Maybe retired, maybe a spouse has already passed away. There's lots of different scenarios in life where a person could say, I don't actually need life insurance for myself. But I would say for most adults out there, probably the vast majority, have at least one person that depends on them financially, at least in part, for their well-being. And so life insurance would be an important component. Also, keep in mind, financially dependent, that could even be a business that you own. It could be somebody that you've co-signed on a loan for them. So you have to think a little bit more broadly, that not just somebody who lives under your roof necessarily, but it could be other financial responsibilities or people or entities that would be at a loss if something were to happen to you. Now, the types of insurance that are out there, this would be probably a whole other podcast episode itself, but broadly they fall into two different categories. You've got term life insurance and you've got permanent. So term and perm, those are the two types. Easy to remember. Permanent means that it's going to last your whole life. You pay the premiums as long as you continue to pay your premiums as you're supposed to. It lasts your entire life, and at some point when you die, be it soon or way down the road, somebody's getting the money. Your beneficiaries are going to get a death benefit. Now, permanent life insurance can get really complicated. There's a lot of different features. Most permanent life insurance, they carry the ability to build a cash value. So as time goes on, you have a cash value associated with that policy. If you finish out that policy or close it prematurely, you can access that cash value. Sometimes you can even access it while the policy is in place. Also, a lot of permanent life insurance policies give you the ability to invest a portion. So you're paying the premium each month to keep the life insurance in place. Part of that money can be invested inside of that life insurance policy and grow over time. However, permanent insurance is much more expensive. Your monthly premiums are going to be much higher because somebody's getting money. So the insurance company has got a bet with you and with thousands, probably hundreds of thousands of others, and they know they're collecting premiums each month, but a lot of that money is going to have to go out in death benefits. So they have to make sure that it's a net benefit for the insurance company. So there's going to be higher premiums that you're going to pay. Also, as a savings and investment vehicle, not as efficient as something that you would just be able to start on your own, like a Roth IRA or even your 401k or these types of things. So yes, you can save and invest. Are there other vehicles that would do that better? Yes. Now, a lot of times whole life is a type of permanent life insurance policy. There's other ones, universal life, variable universal life, etc. But a lot of times they are presented as this is the catch-all solution. See, it's everything. It's your life insurance, it's a savings vehicle, it's an investment vehicle, it's this big hybrid, this only thing that you need for your life. And honestly, the way that is presented, I disagree with firmly. Permanent life insurance is good for some people, and it's appropriate in some cases. But I would say it's mostly been oversold. There's a lot of people that have whole life that just don't need it. And the reason they have it is because the insurance companies and the people who sell those policies, they make a lot of money doing that. And they make a whole lot more money selling you a whole life insurance policy than they would telling you to open a Roth IRA or to get term insurance or to go with other cheaper, more efficient options and kind of a do-it-yourself approach. And a lot of it just comes back down to an incentive. So is whole life or permanent life wrong? No, but you need to be very careful if you are being presented with an opportunity to buy a whole life policy. Be very careful about that. In most cases, for me, I would recommend people get term insurance. Again, not in every case, but in most cases. And term insurance is like it sounds. You have a life insurance for a term of time, 10 years, 20 years, 30 years, and you have an amount, a death benefit that gets paid out if you die within that time frame. So you're 45 years old, I get a 20-year term policy. If I die between now and the time I'm 65, my beneficiaries get the money. But if I don't die, then the policy lapses and the insurance company keeps the money. So the insurance company basically is making a bet with you and, again, thousands of other people. Most of you aren't going to die, and at the end of the 20 years, the insurance company is going to keep the money, but some will, and those will get death benefits paid out. And so the actuaries do the math, and they figure out how much everybody has to pay the insurance company to make sure that they make money in the end. I mean, that's basically how those go. And of course, there's a lot more nuances and things we can go into, but term insurance and permanent insurance, usually term's a better way to go. Much lower cost, way less than permanent life insurance would be. And it's a way to make sure that your family and loved ones are taken care of in the event of your death. And then it frees up more money to go towards those other vehicles, to pay for your, to contribute to your retirement account and to pay for, and to save and to distribute that money in more efficient ways. Now, how much life insurance should you have? That's the real question. That's what we wanted to cover in this podcast today. Think about what life insurance is for. Think about what you're really doing when you buy life insurance. You're replacing your monetary value. That's what's happening. It's kind of weird. It seems a little bit cold and calculating to think of it that way, but it is the reality of how this industry works. You have earning potential. You have the ability to go out there and use your skills and time and talent to make money. And you'll be able to continue to do that for the rest of your life until you die. But if you die, how will your earning potential be replaced? Where will that money come from that your dependents need? So what life insurance is really doing is replacing your earning potential for a certain amount of time. And that's what we have to figure out, okay? How much earning potential do I need to fill in and for how much time? So there's a few ways to do this. I'm going to give you three. There's probably more that people could come up with, but these are the three that I've seen as the most common and the ones that you're probably going to see if you ask around. Number one is a very simple calculation. It's the simplest way. Simply take your yearly income and multiply it by somewhere between 10 to 12. Just real easy. Do it on a calculator. Do it on a piece of paper. For a lot of people, that amount of money, if you make $50,000 a year, you multiply that times 10, boom, $500,000. That's a lot of money, but what you're going to find is in a situation where somebody has died and now their dependents are going to have to use that money to live off of for an extended period of time, that money can go quite quickly. And in this case, it should last about 10 years. That's the whole idea, replacing your income for a set number of years. That gives your beneficiaries plenty of time to have the resources to take care of their immediate needs, navigate, make adjustments, and then go from there. So it's not necessarily meant to set them up for the rest of their life necessarily. It could maybe in some circumstances, but it's more about providing an extended amount of time to take care of immediate needs and make important decisions for the long term and adjust. So that's the simple way. 10 to 12 times your yearly income. A more precise way would be number two, using the LIFE acrostic, LIFE. So that stands for L, liabilities. That's your mortgage, car loans, student loans, credit cards, etc. Any debt that you have. The idea is you die, your debts, you want your beneficiaries to be able to pay them off so that they're not having to worry about making payments on your debt. So add up all your liabilities. Maybe you add them all up and they come to $200,000. So that's your first step. Okay, I need at least $200,000 in life insurance to take care of my liabilities. Then you move to letter I. That's income. how much income needs to be replaced, and for how many years. Like I was saying before, with a simple example, you say, okay, 10 to 12 times. But do your beneficiaries need that full amount? Let's say you've got two spouses. They both work outside the home. One makes $80,000 a year, and the other spouse makes $70,000 a year. And if one of them died, would they need if the spouse that makes $80,000 a year died, does the other spouse and the kids need $80,000 a year to make it? Or could they live with 75% of that? Would they need $60,000? Because remember, with one family member gone, that does lower the family expenses to some extent, and maybe they can make do with 80% or 75%. So maybe it's not 100% of your yearly income, maybe it's 75% of your income. And then how many years? Okay, so maybe in a hypothetical circumstance, okay, we need 75% of the $80,000 a year, and I want to make sure that I replace that income until the kids are through high school and through college. So our youngest will be graduated from college in 12 years. So I need 75% of $80,000 for 12 years. You do the math, that's $720,000 total. Add that to your liabilities. Now we're at $920,000. So L, liabilities, I, income, F is final expenses to pay for your funeral, burial, maybe travel for family members coming in, all of those types of things. This is going to be usually the smallest one. Let's just call that $25,000 for all of those needs right there. So now we're up to $945,000. E is education, because again, if there's kids involved, college education is usually one of the biggest expenses for a family and one of the toughest things to plan around. Now, let's say, and I'm just using a hypothetical circumstance, let's say they've got $200,000 liabilities, $720,000 income, $25,000 for final expenses, but let's say education is actually not a need for them because maybe in this scenario, the grandparents have already set aside money and that's going to take care of the college education. So when they add all those things up, the final tally is $945,000 of need for life insurance. So let's call it $1 million because, by the way, when you go to an insurance company, typically for every $250,000, there's kind of a break point. You get the most bang for your buck at those even numbers. So you go and get $1 million life insurance policy, and that covers your needs under that method, the life acrostic. So there's a simple way, there's a more precise way, and then thirdly, I would say there's an even more precise way. If we want to get real technical, this probably appeals to sort of the mathematical engineering type minds, but it's a way to more or less mathematically calculate the present value of your future earnings, because that's really what you're doing. You're saying, hey, I've got earning potential going into the future as of now, and if I died today, how much money would it take to replace all of that income into the extended future? So really, that's what we're trying to do with this calculation. It's called the human life value method, which also kind of sounds cold and calculating, like, what's your human life value? It's hard to, human life is priceless, obviously, but in terms of a life insurance, we do have to try to find a reasonable number to it. So this method requires a little bit more computing power. It's not something you can do on the back of a piece of paper. But here are the four components that you need to consider to make this calculation. Number one, annual income. So let's say we have somebody that makes $75,000 a year, and then years to retirement. How many more years until they get to their retirement years? Let's say it's 17 for this person, because you reach retirement, Social Security kicks in, maybe pension, 401k savings. It's usually the gap you're trying to get people to from where they're at now to retirement. And then you have to also factor in a discount rate. So it's like, okay, I'm making $75,000 a year. I want to bridge the gap between now and retirement, which is 17 years. But I also understand that the money, if received in a lump sum, it's not just going to sit there and do nothing. Hopefully, you're going to put that money to work to some degree to be at least modestly invested over the long term so that money can grow and at least keep pace with inflation, hopefully beat it a little bit, because if you just have the money sitting there, each year its purchasing power is getting eroded by inflation. You can buy less and less with that pot of money. So you want to put the money to work. The discount rate is what you're assuming the rate of return on that lump sum of money would be. So let's say in this case it's 5%. I think that the lump sum, I'll be able to generate a 5% average annual rate of return for the next 17 years. And then also the tax rate. what's the person's tax rate? Because if they're making $75,000 a year and they are in the 25% tax bracket, that means a huge chunk of that $75,000 is actually not going to meeting their spending needs. A lot of it's going to Uncle Sam. If it's $75,000 a year and they're in the 12% tax bracket, well then a lot more of that money is actually being used. Does that make sense? So that's part of that calculation is, okay, what's that person's tax rate so that you understand actually how much of their annual income really does need to be replaced. So if this person, let's say in the 25% tax bracket, you do all those numbers, $75,000 a year for 17 years, you can earn 5% rate of return on the money, and they're in the 25% tax rate. That means they need a death benefit of $634,000 to make things work. So there's a lot of different ways to sort of slice and dice that problem. And really what I would say for you is if you're looking at trying to find the right life insurance value, take a look at all of those methods. Understand your situation. Would I say all of them, one of them is always going to be the go-to? No, I would definitely lean towards using life or using the human value method and not going with the most simplistic. But at the end of the day, I would much, much rather somebody have life insurance and be a little inaccurate with it than sit on the sidelines and say, well, I just don't have life insurance because I don't know how much I need to get. So take that step. If you need some recommendations, I have some places that I usually recommend to people to shop for term insurance. A lot of different places you can go. You just want to make sure you shop it around. Don't just talk to one or even two different insurers. Make sure you're comparing multiple options. At the end of the day, term insurance is pretty straightforward. Here's the rate, here's the amount of time, here's the death benefit. There's not too much else they're doing for you. It's not like home or auto where it's a little bit more complicated. So if you have any questions about life insurance, if that's a question you've been trying to tackle and I can help you with that, feel free to reach out to me, info@nateskelly.com, or you can reach out to me via our Facebook page, Financial Pathway. So hope that was helpful to you. If you haven't got life insurance, put it on the to-do list, get that taken care of as soon as possible, and you'll sleep a lot better for it. Thanks, everybody. I'll see you on the next episode.